My name is Mehdi Amini, founder of American Mortgage Group. I get the question a lot of what happened when the meltdown happened in 2008. Very important question. Everyone's looking at their current financial situation. Interest rates were at 40-year lows. They're looking to refinance their home. They're looking to purchase a house. What does that mean to you in your unique situation? You know, two major things I see in the mortgage industry after the implosion. And those two things are, number one, loan to value. Value started to drop. And the private banks, the private lending institutions in the United States stopped lending money over 80% loan to value. So if you didn't have at least 20% equity in your property, you were not getting a loan. You saw a huge flux of foreclosures and short sales started to come out. No one even knew what short sales really were. Banks started negotiating. Folks started to try to modify their loans. And the government had to come in and really save the mortgage industry. And so the government came out and fixed the loan to value, meaning they started lending money to folks that were over 80% loan to value. Number two, the biggest change in the marketplace was debt to income ratio. So again, loan to value and debt to income ratio. Debt to income ratio wasn't a factor prior to the meltdown in getting a loan. In today's market today, it is everything. You have to qualify with your supporting documents, supporting your income, and your debt to income ratio with your mortgages and minimum payments needs to be below a 50% debt to income ratio. Prior to the implosion, this was really not an issue. There were stated income loans. So a lot of folks today don't qualify for loans, either A, due to their debt to income ratio, or B, due to their loan to value. So really looking at the present and what the changes that were made that I believe that really helped the industry is the government came into the marketplace and started to do loans with the Federal Housing Administration all the way up to 97.5%. You're able to combine your first mortgage and your second mortgage. A lot of folks had these second mortgages at high rates, whether they were adjustable rate mortgages. Now, you do have to qualify with your debt to income ratio. In today's market, your debt to income ratio needs to be below 50%. But I believe, as a founder of American Mortgage Group, that the fundamentals of the mortgage industry needed to change. And I think with the income qualifications that we see in the marketplace after the implosion and all the way to now, I think we got the basic principles back to lending, especially for housing. And I think that we are seeing a great recovery because of that. But I'll never forget when the day came, it was like Armageddon. The implosion happened, everyone was in mortgage banking, everyone was a broker, and everyone disappeared. It took the strong, the visionaries, folks that really believed in the fundamentals of mortgage banking to stick in the game, as I'm one of those individuals, and really learn where the future was going to be. And we stuck in it, and we're here today. And so that learning experience, being there in the best days in the market and being there in the worst days in the market, I believe puts passion in our hearts. Go out there, talk to someone, look at your current situation, decide what it is that you can do. And again, if it's not time for you to refinance or purchase a home today, our goal is to not send you away. Our goal is to find out exactly what we need to do or you need to do to get you to that end goal. And that's either to purchase or refinance a home as soon as possible.